Welcome back to my channel. Don't forget to like, comment and subscribe. How to pay off credit card debt. Part 2. Getting rid of credit card debt can provide immense relief. Carrying debt is stressful, and high interest rate loans can put a strain on your finances. But it's possible to pay off your credit card debt. You just need a solid plan. To help you tackle your balances, we'll cover how to build the foundation you need to eliminate your debt and share some tactics you can employ right now to succeed. We'll also explain strategies that may be appropriate for people who are feeling financially strong, as well as a few techniques for people who are having a harder time. Let's get started. Debt Snowball versus Debt Avalanche. The big picture goal is to pay off your debts. While it might make mathematical sense to use the debt avalanche, it doesn't make any sense unless you actually pay off debt. If you get discouraged and lose motivation, or see that in your future, try the debt snowball instead. If you want to see how these two strategies compare for your debt, run the numbers yourself. It's not terribly difficult to build a table showing how your credit card payments and extra payments work. Consolidate at a lower interest rate. High interest rates make it hard to get traction. Even as you work hard to make your payments, it might feel futile when you see the interest charges piling onto your balance each month. Minimizing those interest costs can help you save money in the long run and get out of debt faster. Zero balance transfers. Credit card issuers sometimes offer promotional balance transfers with a 0% annual percentage rate, APR. You can use those promotions to move your debt to a new card and, temporarily, avoid interest charges. Make sure you know what interest rate you'll pay when the promotion expires, in case you're still working on that balance. Also, keep an eye out for any balance transfer fees that could reduce the benefits of transferring your debt. Debt consolidation loans. If you don't have any luck with 0% offers, a debt consolidation loan could help. If you can find a personal loan with an interest rate that's lower than the one on your credit card, you can save on interest each month. Don't coast once you have that lower interest rate. It's critical to keep paying down the balance aggressively, which might mean paying more than the minimum on your new loan. Negotiate with lenders. It might be possible to get a lower interest rate without moving your balance. If you're not confident about getting approved for a consolidation loan at an attractive rate, try negotiating with your current card issuer. Contact your card issuer and ask them to lower your interest rate. To improve your chances, highlight why the card issuer might benefit from working with you: your history of on-time payments, your long-term relationship, or your improved credit score. You could also mention any recent hardships, such as a job loss or unexpected medical expenses. Using this strategy, one phone call could save you a substantial amount of money. Cutting the rate on your credit card means more of each monthly payment goes toward reducing your balance. With a smaller balance, and a lower rate at which it'll grow, paying off debt becomes easier. Use the solutions described above to go as far as possible on your debt payoff journey. The options below should only be used as a last resort, because they could potentially make things worse. But sometimes, it makes sense to take desperate measures. Consider a loan from your retirement account. Rating your retirement savings to pay off debt is generally not recommended. Retirement accounts are often protected from creditors, so lenders typically can't force you to withdraw those funds to pay off debt. Plus, time is an important factor when saving for retirement. Taking retirement plan loans and withdrawals can slow your progress toward retirement or require you to start from scratch. But if you have no other options, using a loan from your retirement plan to pay off credit card debt could make sense, as long as both of the following statements are true. You're paying extremely high rates on your debt. You're confident that you will repay the loan. Unfortunately, it's hard to predict whether or not you'll be able to repay the loan. Life brings surprises, and if you leave your job before paying off your 401k loan, you may need to pay taxes and penalties. You may also need to repay the loan in full. Not all retirement accounts offer loans. An employer-sponsored plan like a 401k, 403b, or 457b may have a loan feature, but your employer decides whether or not to include that option. Individual retirement accounts like traditional or Roth IRAs do not offer loans. You might be able to take back contributions from a Roth IRA, but you'll pay a 10% penalty if you're under 59.5. Thanks for watching. Don't forget to like, comment and subscribe.